You're watching Mirror 7 News. Stay informed, stay ahead for more news.
This week, the focus has been on CSL, one of Australia's most prominent healthcare companies, and the way its future has been interpreted by analysts versus the broader market. Morningstar's research team has provided an updated view, and while investors remain cautious, their outlook is far from bleak. Right now, the market seems weighed down by skepticism. The concern comes mainly from CSL's plasma business, Behring, where profitability has struggled to bounce back to pre-pandemic levels. Over the last 3 years, margins have barely budged, largely because of higher plasma collection costs. With CSL's decision to demerge its vaccines division, Seqirus, investors appear doubtful that stronger profits will return anytime soon. This pessimism has already been baked into CSL's share price, which implies Behring's gross margins will remain flat for the foreseeable future. Morningstar's analysts, however, argue that this assumption is far too conservative. They are forecasting a rebound of around 6% in margins by the 2028 financial year. Most of that recovery, about 80%, is expected to come from efficiency improvements. These include collection innovations that speed up donation times by 30%, and boost overall plasma volume collected per donor by around 10%. In short, productivity gains are believed to be achievable, and those improvements could flow directly into higher margins over time. Another major cloud hanging over CSL is the potential for U.S. tariffs on pharmaceuticals. Headlines about possible tariffs as high as 250% have stirred concern, especially since roughly 10% of CSL's cost of goods sold could be exposed. In theory, that kind of hike could slash earnings by as much as 30% and drag Morningstar's fair value estimate for the company down to levels close to the current share price. But analysts remain unconvinced that such a worst-case scenario will play out. The reasoning is fairly straightforward. Plasma-based products are considered essential. Imposing heavy tariffs would not only risk raising healthcare costs in the U.S., but also jeopardize supply for critical treatments. For that reason, plasma products were exempt from past tariff rounds, and the expectation is that they would be exempt again. Even in a scenario where tariffs of 15% or more were introduced, CSL could shift more manufacturing into the U.S. While that would come with a hefty price tag, around $2 billion, the impact on valuation is estimated to be just a modest 2% reduction. So, while market sentiment suggests CSL is under pressure, the case laid out by Morningstar highlights a different story, one of efficiency-driven margin recovery and limited tariff impact. For long-term investors, this paints a more optimistic picture than the share price currently reflects. The company may be navigating a challenging environment, but opportunities for growth and resilience remain firmly in play. Stay subscribed for more videos.